Welcome back to the Block Analyst, where we break down crypto markets with data, context, and zero hype. Today's episode, a deep dive into the SEC's proposed rule change that could unlock a flood of new crypto ETFs. Quick disclaimer, nothing in this video is financial advice. This is analysis and commentary only. Always do your own research before making any investment decisions. So, what's happening? The U.S. Securities and Exchange Commission, SEC, is considering generic listing standards for exchange-traded funds, ETFs. In plain English, this means ETFs tied to certain crypto assets could be approved automatically if they meet preset conditions, instead of waiting months for individual SEC sign-off. Here's the key shift. Currently, each ETF needs a case-by-case SEC review, often 240 days or more. Under the new proposal, qualifying ETFs could launch in as little as 75 days. That's a massive reduction in friction. It opens the door to a wave of new ETFs beyond Bitcoin and Ethereum. Let's take stock of where we are now. Bitcoin spot ETFs launched earlier and proved wildly successful, pulling in billions in assets. Ethereum ETFs started slow but have gained traction in recent months. Investors are now asking, what comes next? The short list includes Solana, XRP, and potentially other large-cap tokens, all candidates for ETF products if standards are approved. Why does this matter for markets? Because ETFs are the bridge between traditional finance and crypto. They lower the barrier to entry for retail and institutions. They provide regulatory clarity and a safer wrapper for exposure. They unlock massive pools of capital that won't directly custody tokens. If rules shift, expect new liquidity channels into the space. This isn't happening in a vacuum. Washington is slowly pivoting toward friendlier crypto policies. The SEC under current leadership recognizes that demand for structured, regulated products is undeniable. As one commissioner put it, the time for crypto has come. Investors need clarity, not uncertainty. Opportunities. Diversification. Investors could access not just BTC and ETH, but Solana, XRP, and more. Institutional adoption. Pension funds, asset managers, and banks could scale exposure faster. Liquidity growth. Billions of inflows could pour into new markets. Risks. Regulatory overreach. Standards may be strict, excluding many tokens. Fragmented liquidity. Too many ETFs chasing limited demand could dilute volumes. Market volatility. Fast inflows can create bubbles, fast outflows can crush prices. So let's think through three possible scenarios. Scenario A. Bitcoin and Ethereum stay dominant. Even with new ETFs, institutions stick to the majors. Other ETFs see modest flows. Scenario B. Selective expansion. A few large-cap tokens like Solana or XRP get ETFs creating strong but niche adoption. Scenario C. ETF floodgate opens. Multiple crypto ETFs launch at once, attracting significant retail and institutional demand, triggering a new wave of mainstream capital. If this rule passes, here are the signals I'll watch. ETF filings. Who's first in line for new products? Liquidity metrics. Do assets like Solana or XRP show enough trading depth? Capital flows. Are institutions diversifying beyond BTC and ETH? SEC commentary. The fine print matters. Standards may include hidden restrictions. Bottom line, this proposal could redefine the ETF landscape for crypto. It accelerates approvals, diversifies products, and brings crypto further into the regulated financial system. But execution matters. Not every asset will qualify, and not every ETF will succeed. So, what do you think? Are we about to see a deluge of crypto ETFs? Or will Bitcoin and Ethereum remain the kings of regulated markets? Drop your thoughts in the comments below. If you found this breakdown useful, hit like, subscribe, and turn on notifications. More data-driven insights are coming right here on The Block Analyst.